When you think of building wealth, you can almost think of it like a snowball effect because of compounding interest. So to use very simple numbers, if you had $100 and that $100 earned 10%, you now have 110. If you earn 10% again, you're earning 10% on the 110, no longer on the 100, which creates a bigger growth rate, and so forth, so on, and continues to compound. That's one part of the equation when it comes to building wealth. The second part is that compounding happening with tax involved or not with tax involved? So tax protected accounts that allow for tax-free compounding of wealth can create a tremendous more amount of wealth in the long run than accounts that are compounding and paying tax along the way. You can think of that like a snowball, but it's melting a little bit every year because of the tax being due. And what we have to understand is when you pay a tax, you're not just paying that tax, but there's also a lost opportunity cost for that payment. So in other words, if you were to pay $1,000 in a capital gains tax, you're now losing the opportunity of what that $1,000 could have earned for you over 10, 20, 30 years if it otherwise was in your pocket to invest. We also look at taxes from a retirement standpoint. Is all of your retirement money subject to taxation upon distribution? This leaves a big risk because if you're contributing into something today pre-tax, meaning you're getting a deduction today at current tax rates, but you have to pay a tax in the future when you distribute at an unknown tax rate, there creates a risk there. If taxes rise, you can lose value from an overall standpoint because of the tax situation. Now that can also play out in your favor, but it's a risk on the table. We have to be very considerate of taxes when we're investing.